Hi everyone. In this video we're going to go over a series of questions that the textbook is going to ask you to determine. It will ask you to determine goodwill. It's going to ask you to determine the consolidated balance sheet for assets, consolidated balance sheet for common stock, consolidated balance sheet for retained earnings. Okay. So this one we're going to break down because there's a lot of different things that's being asked in this problem. So here's the problem. On July 1st, True Data issues 10,000 shares of its common stock with a $5 par value and a $40 fair value in exchange for all of Webstat's company's outstanding common stock. Okay. I stop. Who is buying who? So True Data is buying Webstat. True Data will be the parent. Webstat will be the subsidiary. So I have to figure out a series of pieces. All right. First thing I'm going to do is I'm going to figure out the purchase price. All right, so what did they tell us? They said that True Data took 10,000 of its own shares of stock and purchased Webstat. What I need for the total purchase price is the fair value of the stock. So what is that stock selling at today? I read it, it says $40. So my purchase price, I am going to take 10,000. I'm figuring this out as I'm working with you. And I'm going to multiply that by 40. So my purchase price is $400,000. Okay, now, always get in the habit of this. This problem's not going to have us do journal entries yet, but once we start doing journal entries, you will have to break this out. All right. So the total purchase price is $400,000. But now I'm going to break this out. I want to look to see what the company's par value is. So the company's par value is $5. I'm going to take that and multiply it by 10,000. And you all know that's the amount I will credit to common stock. So my answer here is 50,000. Remember, additional paid-in capital is always the difference between the purchase price minus, or the amount issued minus the par value, the common stock. So my additional paid-in capital is $350. I'm going to need this later on. Okay? All right, so I go back to the problem. Let me put this down now. All right, so I go back to the problem, and it says, it gives me the information over here. So here's the book value, here's the fair value. Remember, when we're figuring out goodwill, we always use the fair value. Now, if book value is the same as fair value, then we will use that exact number. All right, so how do we get goodwill? All right. So let's first figure out, well, we already figured out the purchase price. So the purchase price is $400,000. Next, I'm going to subtract the net assets. And that will equal my goodwill. Okay? All right, so I look at the problem. All right, I'm trying to figure out my net assets. And this will not include, I'm trying to figure out the goodwill. All right, so I'm going to take the cash, which is $60,000. Now, what I'm doing first is only figuring out goodwill. When I start doing the second part of it, when I show you the adjustments, I'm going to show you we'll do something different. But right now I'm showing you how to figure out goodwill. So we're going to take 60,000 plus 175 plus 200 plus 225 plus 75, and then we're going to minus 350. But why am I minusing 350? That is my liabilities. And when I do that, my net assets are 385,000. So my goodwill is 400 minus 385,000, and that gives me 15,000 for goodwill. Remember, goodwill is an intangible asset. Okay, now I'm going to step back, and I want you to get this down. So you can pause the video right now. I want you to get this analysis down. You're going to have company implied fair value, the parent purchase price, non-controlling interest. Over to the far left, you're going to have company fair value. You'll have book value of the net assets. No goodwill in this number, and this is the subsidiary. This will equal your total. Next, you'll have your adjustments, and I'll go through how you get those adjustments. This will also equal a total. Let me step back. This total and this total must always match. If they do not, this is how you can catch you did something wrong. So in this particular problem, liabilities changed. Liabilities went down. How would you have to decrease liabilities on your books? You would debit those. So you're going to see when we're done, we will show liabilities as a positive. Why? Because the fair market value went down. All right, so we went over how to get goodwill. All right, that's the 15,000. Okay, now I'm going to go over this analysis. This, we're going to start off slow. This particular problem, they purchased 100%. 100% of this other company, but it's still staying in existence. It's consolidation. They paid 400,000, so I put the 400,000 here. All right, the company implied fair value is exactly the same because it's 100%. Later on, I'll show you what you do when it's less than 100%. But right now, it's 400,000. You'll learn, you'll subtract the two. The non-controlling interest is 0. No one else owns this company besides you. You're the sole owner of this company. All right, next, you're going to figure out the book value of the net assets. All right, so let me show you. The book value, you can can't really see it. The book value you're going to get from the book value category only. Don't look at fair value for this particular analysis. All right, and when you do, and you total those up, you will notice those equal 300,000, okay? You'll subtract them, and that will give you 100,000. All right, now, my total better equal 100. All right, let me quickly go over how you get that 100. You will look at book value only. You will take 60 plus 145, book value, plus 180, plus 200, plus 75, minus 360. That's the book value of the net assets, 300,000. All right, now we're going to go through on how to do the adjustments, okay? So I showed you a little bit differently than the publisher. Why? To make your life easier, because these problems get daunting. They get very difficult, and if you don't have a check, you might miss that a liability should have been a debit, not a credit. So I'll show you how this can catch some of your errors, okay? All right, so let's go over here. All right, now, this is a consolidation. we're only going to make adjustments for the difference between fair value and book value. If the fair value and book value is the same, we will not make an adjustment, because when we consolidate, we'll include that. Okay, so one more time, we will only make the adjustments when the asset or liability has changed, their fair value is different. All right, so let's look at this problem. The first difference I see is inventory. So inventory was $145. The fair market value is $175. The difference between the two is $30,000. It's inventory, it's an asset, it went up. You will show that positive. So I'm going to go over here and I'm going to put in inventory, 30,000. All right, also get in the habit of, later on when I teach you the journal entry, this is going to make your life easier. Put the word debit so you know when you do your journal entry what you're going to do. All right, now we go to the next item. It says patented technology. A patent, absolutely, that's a nice asset. All right, so it was 180. The book value, the fair value is 200. So I am going to make an adjustment for 20,000. And also, get in the habit, I'm going to tell myself what I'm going to do. I'm going to debit that. It's an asset, and increased. In order to show that increase, I will debit it. All right, next I look on is land. Did land change? Yes. Land changed from, it was 200, the fair market value is 225. I'm going to go over land. It's an asset, it increased 25,000. I will show as a debit. I go to the next one. All right. Let's show our assets first. Okay, so I don't forget this or you won't tie out. Remember, we figured out goodwill. So what is goodwill classified as? Goodwill is an asset, an intangible asset. So don't forget that. I'm going to put in goodwill, 15,000. But if I forgot it, you will see you wouldn't tie out, and that's how you can catch your error. Debit. All right, now let me go look what else has changed. Okay, liabilities have changed. Liabilities on the books were 360, but the fair market value is 350. That could be a discount on a liability, but anyways, so your liabilities went down. You're going to have to debit your liabilities. How much? $10,000. So go over here and you put liabilities, a debit, and show that positive. I'm running out of room, everybody. $10,000. All right. Oh, hate when that happens. All right, let me kind of do it over here. This is my total. All right, so now we're going to take 30 plus 20 plus 25 plus 15 plus 10, and that equals 100,000. These two numbers always have to match, okay? So here's what you could have done. Maybe you showed the liability as a negative, right? Well, then you wouldn't tie out. You would come down to 90,000. So you would not tie out. So you would go back and look at the problem and see, oh, I analyzed that wrong. All right? So that's how you would do that particular analysis as far as how it would show. All right? So you got inventory 30, patented technology 20, land, goodwill, liabilities. Okay. Here's the next question it asks. Now remember, this is consolidation. Who's the parent? True Data is the parent. Who's the subsidiary? Webstat. So Webstat is going to get consolidated with True Data. Here's the question that it's asking is, On its acquisition date, consolidated balance sheet, what amount should True Data report as patented technology? Okay, so let's look for the patent. I go over there. True Data is 230. That's the parent. And then I'm going to add in only the fair market value. So 230 plus 200 gives me 430,000 D. All right, now 18. On an acquisition date, consolidated balance sheet, what amount should True Data report as common stock? All right, remember, when you do a consolidation, you will only include the parent's equity accounts. The subsidiaries' accounts get wiped out. So you will only include the parent's equity accounts. All right, so I go over, I look. What was True Data's initial common stock? True Data only. Now, True Data only. Their common stock, remember, ignore Webstat, ignore that 70, was 300. But don't forget, they issued more common stock. So the amount to common stock would be 300 plus 50. That would be 350,000. Okay? All right, B, here's what it says. On its acquisition date, what amount should True Data report as retained earnings as of July 1st? Okay. Remember, we only include equity accounts of the parents. Okay? All right, so I go look. What was True Data's beginning retained earnings was 130,000. I find that right on their balance sheet. Okay? And then just make sure. Where's the retained earnings? Oh, that's weird. They're showing it right above, right after revenue minus expenses. But their retained earnings was 130. Don't forget, subtract out to figure out the net income. True Data revenue is 250 minus 170, and that gives you 80,000. You will take 130 plus 80,000. So the consolidated balance sheet for net income will only include the parent, and that is 210. Okay? All right, so that's how you do that problem. Get in there, work in the lab, and then you're good for the homework. All right? I'll see you soon.